Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. Welcome everyone on all major podcast platforms and also on the Fun with Annuities YouTube channel, where you can see me and the guests interact. We have a repeat guest because there's no way we can ever get all the information out of his head. He is known affectionately as America's #1 retirement expert, which coincides with me being America's annuity agent. But he truly is one of the most knowledgeable people I know in the field of retirement, and that covers a lot of things. But today's topic, we're going to talk about taxes. Now, his name is Bob Carlson. You can find him at retirementwatch.com. I'm going to have a page set up for him, just like I did for the last time that I had him on for the podcast. And I do encourage you to go to his site and sign up for his free e-letter and all that stuff. His site, you could spend a month there and never get half of it. There's that much there. I was on it just right before we went on, and I just was like, holy mackerel, there's a lot of stuff. But then again, Bob Carlson's been doing this a long time. Bob, welcome to Fun with Annuities.
Thank you, Stan. Good to be here.
Great. Let's talk taxes. I'm just going to kind of throw you the ball a little bit because the phone's ringing off the hook on my end about what's being proposed, what's in the books, what's going to happen. Can you just jump in and just start talking taxes to the people out there that love to hear what you have to say?
Sure. There's a lot. Well, there's a lot being talked about in Washington. There's not a lot going on yet. There've been a lot of proposals, counter proposals, negotiations. So basically nothing's been done, nothing's been agreed on, but there are a lot of really actually scary proposals out there for a lot of people. Increases in income tax rates, dramatic changes in the estate tax that would eliminate a lot of strategies that have been in place for decades and used by many different people. Changes to IRAs, other things. All these things are are being proposed, but there's always just enough votes so far to keep them from reaching agreement. So, it's hard to say what's going to pass by the end of 2021 or if anything's going to pass. Apparently this week, the last week in October, is kind of the make or break week, according to most people in Congress, although in the past, they have come back after Election Day and made deals in November and December. So that's still a possibility. But, you can't say anything definite is agreed to or ready to go. There's a lot of things that seem to have been agreed to at various points in these last few months. But then a week later, reports are that someone didn't like it, so it's not going through. So what we know is that a majority in Congress wants to increase taxes, but it doesn't know or can't agree on which taxes to increase, who to increase them on. And so it's difficult to do any year-end tax planning this year because we don't know what the tax rules are going to be next year.
I saw something the other day that just the word combination made no sense to me. Unrealized capital gains. Bob, been doing this a long time with you. That's a new one on me. And I know they're only talking about the quadrillionaires, but me and you both know that it somehow seeps its way down. Unrealized capital gains?
Right. What? It's also called mark to market. It's something they do impose currently on futures traders, but not on anyone else. And basically, what the proposal is that at the end of each calendar year, you look at your portfolio, your account statement, and anything that has positive appreciation in it, they're going to include that appreciation on your tax return for the year and tax it. And now currently they're saying we only plan to do that on the 400 or so billionaires in the country. But, like other things, it's a foot in the door. It's a first step.
Yeah.
Um, and initially the proposal was they would do that for estate taxes. When people died, they wanted to tax their unrealized gains rather than stepping up the basis at death. That was rejected by a majority of people in Congress finally, so they've moved to this other one where they plan to do this mark to market at the
Mm.
end of each year.
Which the first thing I thought of was the privately held business.
Yeah.
That's valued at a certain level, but if you tried to sell the shares in that privately held business, it wouldn't equate to what is being valued. I mean, I just don't see how they can pull that off.
Yeah, the people proposing it say it's modified in several ways. It'll only be publicly held assets and
Okay.
some other things. So, but even so, if someone has a controlling interest or even a big minority interest in a publicly held company, and they have to sell off 1% of their shares each year just to pay the taxes, that's going to affect number one, the stock price. And
Hmm.
it's going to affect a lot of stock prices if everyone knows that the billionaires have to sell off a portion of their shares by the end of the year. And it's also going to change the way these people invest. They might take the companies private, or they might decide they don't want to invest in any public companies in the future and gradually shift their portfolio over to private. So it really has the potential to shrink the market of publicly held shares and limit the investment options for regular people just because of this tax on billionaires.
There's always a reaction to the action, and that's what I think the politicians always miss. They look at things statically
Mhm.
initially, and they're like, well, if we do this, then that's what we're going to get. Not the reason rich people are rich, and the majority of the people that are listening to this podcast are consumers. They've scrimped and saved, they put money away, and whether they consider themselves rich or not, they probably are. And now it seems like everything's targeted toward them. I was on your site, and there's a breaking story that link that you had about Congress coming for people's retirement money.
Mhm.
Explain to the people, obviously, I want them to go to your site. Again, it's retirementwatch.com, all one word, retirementwatch.com. Please pin that. Please put that in your favorites. What are we talking about, Bob, with Congress coming after our retirement money? What's your take on that?
Well, Congress for decades, since the early 70s, has given people a lot of incentives to put money away into qualified retirement plans. Gave them upfront tax breaks so that they'd put that money away, let it compound for years, get that tax deferred compounding, and eventually take it out. And so now there's trillions of dollars in these IRAs and 401ks and other retirement plans. And Congress has gotten tired of waiting to impose the taxes on the back end. So it's trying to accelerate some of these taxes or increase the rate on them. The big move it made was in the 2019 Secure Act, where it eliminated the stretch IRA
Right.
and said when people inherit an IRA, they can no longer take the required minimum distributions over their life expectancy. Instead, the whole thing has to be distributed in 10 years or less. So that accelerates the taxes. It also lumps the income into a limited number of years, so potentially puts you into a higher tax bracket. So
Mm-hmm.
it increases the taxes on inherited IRAs. They've also done things like when you convert a traditional IRA to a Roth IRA, initially you had a chance to reverse that in case something went wrong. But they also eliminated that in the 2017 tax law. So you can no longer, if you convert an IRA, it's a done deal. You no longer get a second chance. You no longer can, if circumstances change, then change your strategy. So you're stuck with that. So that's, another hindrance on retirement planning, another elimination of a strategy that was useful to many people, not just wealthy people, but just, middle class, upper middle class people use that very effectively. And there are more proposals to do additional actions like this in the future, where you accelerate the money that has to be taken out of retirement plans so it gets taxed faster. Of course, the increase in tax rates that are proposed would affect retirees when they take the money out.
Mm-hmm.
There's also what I call the stealth taxes, which primarily hit retirees, things such as the tax on Social Security benefits that used to be tax-free, but they're taxed now if your income goes above a certain level. And so if you have to take an additional dollar of income, you not only include that dollar of income in your taxable income, but you include up to 85 cents of your Social Security benefits that you received already. So for each dollar of extra income you earn, you're including $1.85 in your taxable income and paying taxes on it. There's also the Medicare premium surtax, also known as IRMA. As your income goes up, you pay higher Medicare premiums. So, they can increase taxes on retirees without increasing tax rates just through these stealth taxes, through these accelerated distributions from retirement plans and things like that. And that's what they've been doing the last few years. And I think they're going to do more of it going forward.
What, for everyone that just forgot who that expert was, that's Bob Carlson of retirementwatch.com. And he is known by many, and me as, this is what I call him. He's America's #1 retirement expert. You just heard him go freeform with about a zillion things, which means you need to go to his site and certainly just sign up for his stuff and follow what he does. Bob, I have a question about Roth IRAs. I get a lot of questions right now because there's some proposals that the Roth IRA strategy is going to be messed with a little bit by Congress. What are you hearing? I know that you have some really direct contact with DC, and DC certainly follows what you say. What are you hearing about the Roth IRAs?
Well, of course, they got back into the headlines a little earlier this year when a website published some stolen IRS data and said there's one billionaire who had a $5 billion Roth IRA.
I saw that. Wasn't that fantastic? For the people that don't know, there's a person that started a Roth IRA just under the same rules as me, you, and Bob, and he's grown it to $5 billion. So that made them mad because he followed the rules.
Yeah, he followed all the regular rules, didn't do anything illegal or even under the table. He just bought PayPal shares privately when they're worth a few cents a share and held on to them. So now he has a very valuable Roth IRA. So some people in Congress have decided, well, there's issues with Roth IRAs. So they're looking at several potential changes. One would be to simply cap the amount you can have in any kind of IRA, really, but particularly Roth IRAs, where they say if your IRA goes above a certain value, then number one, you cannot make any additional contributions or conversions. But in addition, you might be required to distribute part of that, no matter what your age is, even though the original Roth IRA rules said there'd be no required distributions. But they don't want these IRAs getting above a certain amount. At least some of the people in Congress don't. So they're proposing that. And then on the other end of it, there's Secure Act 2.0 that's in the works, where they want to eliminate some of the front-end benefits of 401k plans. One of the proposals is that for employer matching contributions to 401ks after 2021, those would have to be treated as Roth contributions rather than traditional contributions. So the employer would put it into the IRA, the 401k, but the employee would have to include the matching contribution and gross income and pay taxes on it.
That's crazy.
Yeah,
who's thinking this up?
Well, the way it works is when they put benefits in the tax law, and there's a lot of benefits in the Secure Act 2.0, they have to, quote, pay for it by raising taxes in some other way. And that's why they eliminated the stretch IRA in the original Secure Act, is to pay for the other benefits. And so one of the ways they want to pay for the benefits in Secure Act 2.0 is to force some parts of 401ks into Roth versions rather than traditional versions, so the taxes are paid up front and offset some of the tax, basically revenue loss that are from the other provisions.
I always tell people when if I was on the outside of the meeting when they first voted for the Roth and it came through, I guarantee you, as they're walking out of the meeting, Congress people are trying to figure out how to tax it. And what you're saying is that promise of never taxing the Roth IRA might just have a few asterisks beside it saying, oh, except for this, right?
Right. I know some financial advisors who from day one of the Roth IRA said, don't do it. It's a trap. Eventually it's going to be taxed. You're better off doing other things rather than relying on that. Initially Social Security benefits were tax-free.
Mm-hmm.
Now for most people they're not. Medicare premiums were supposed to be the same for everybody. Now if you're higher income, you pay a higher premium. And there are a lot of things like that in the tax code where, initially they encouraged you to do certain things, promised you certain tax benefits, and later on they said, well, it didn't really work out the way we intended, or we need the money, so we're
Yeah.
going to have to change this.
Well, and I always tell people, always think of, like when people would always argue with me, because I would say, there's a possibility, and I remember saying this 5, 6 years ago, 10 years ago, there's a possibility they'll change the rules with Roth IRAs, and people would come back, no, that's never going to change, etc. And I always say, think of the Roth IRA holders as a voting block. It's a very, very small voting block when looked at the 300 million people in this country, etc. So the Congress has no problem making that small voting block mad, or framing that small voting block of Roth IRA holders as the evil rich. They could easily do that with the media's help. And it sounds like they're getting ready to throw that trial balloon out there to see if it sticks, right?
It's kind of interesting, some of the dynamics of this, because I always felt the financial services industry were very powerful lobbyists and would protect the Roth IRA. But when they coupled it in Congress with the Secure Act and Secure Act 2.0, the financial service companies have started to look at these other benefits of the law that would channel a lot of money into 401ks and some other things. And they thought, well, we don't mind giving up some of these Roth benefits because we'll get more money under management from these other benefits. So that's kind of what's happened, is the financial services industry, which defended the Roths for a long time because it increased their assets under management, are willing to make this trade for 401ks or defined benefit plans under management instead of the smaller amount in Roth IRAs.
Explain the backdoor Roth, because that gets thrown around, that little saying, what that is, and the future of that, if there is a future, if it's the future, if the door's already closed. No pun intended.
It's good at least through the end of this year. It's one of the items on the target list. It's not clear it will be eliminated after this year, but it's possibly going to happen. What it is, it's like a 2 or 3 step strategy. First of all, you need to be employed, have an employer 401k available to you, and that 401k has to allow after-tax contributions in addition to the pre-tax. Most people know about the pre-tax 401k contributions, which go up to about $19,000 a year. But you're allowed under the tax law to make additional contributions. In fact, you can make a total of up to about $58,000 in contributions, but the ones above that $19,000 or so level will be after tax. They'll be included in your gross income. You'll pay income taxes on them, but they'll be in the 401k. And then the trick there is you can eventually roll them over to a Roth IRA, tax-free. And particularly if your 401k allows what they call in-service distributions.
Right.
You can take a distribution or a rollover anytime after age 59 and a half. You don't have to be retired or leaving the employer for those after-tax contributions. So you can just take them, roll them over each year to a Roth IRA, and there you have about $38,000 of money in a Roth IRA because you made those after-tax contributions to the 401k and then took the in-service distribution. So that's what's available. It's what some people have used. They have income levels that exceed the level at which you can make Roth IRA contributions. You can't make a contribution when your income goes above a certain level.
Mm-hmm.
So they have excess income. They're not allowed to make regular Roth IRA contributions, but they can use this backdoor strategy if they have the 401k plan in place and make after-tax contributions to it.
Now you've talked about the coming tax increases, and you're a pretty good predictor of what's going to happen. Are there some tax strategies that you think will survive the coming tax increases? And if so, what are those?
Yeah, there are quite a few that have not been discussed in Congress and that are pretty widely used and
Okay.
popular. One of them you're familiar with is the QLAC and
Mm-hmm.
IRAs, where you can avoid required minimum distributions by investing part of your IRA in a qualified longevity annuity contract.
And I think the
And
reason for that, Bob, is the IRS and the Treasury Department are the ones that built it and designed it and introduced it.
Mhm.
So, so I guess to them it's perfect, right?
Right. And also, in fact, in Secure Act 2.0, there's a proposal to increase the amount you can put into the QLAC. So
Let's hope.
if that is enacted this year, as I think will happen, there'll be an additional benefit to that. So it not only won't be eliminated, it'll be enhanced.
And by the way, for people, you can go to my site at theannuityman.com and run your own QLAC quotes 24/7 on the best annuity calculators on the planet. So just put that in mind if you want to see what that is and the rules. And I've written books on it, so you can get that as well. What are the other things, Bob?
Another one also for IRAs, it's called the qualified charitable distribution. Required minimum distributions are a problem for a lot of people. They don't
Mm-hmm.
plan for them. They get into their mid or late 70s and they're finding they have to take more money out of this IRA than they want to. They're forced to take it out, include it in their income taxes, so it increases the taxes on their Social Security and increases their
Mm-hmm.
Medicare premiums. So one way you can get around that is you can have a charitable contribution made directly from your traditional IRA to the charity. It will count towards your required minimum distribution for the year, but you won't have to include it in gross income. So it's a tax-free way to move money out of your traditional IRA if you're making charitable contributions after age 70 and a half. That's the way to make them. You don't want to be writing a check to charity from income you've already paid taxes on. You have pre-tax money in the traditional IRA. Instead, just make that money be your contribution to the charity. You just tell your IRA custodian where to direct the money to. It'll do that online and just
Mm-hmm.
send you a statement that it's made the distribution. And so you've handled your required minimum distribution without any income tax burden.
It's
So,
called a qualified charitable distribution, a QCD. I'm trying to figure out why this isn't more widespread and known, because you're really the only person that I have found that really does a good job explaining it.
mhm.
But that's interesting. What else is out there that's gone under the congressional radar screen?
Well, health savings accounts, which are the only triple tax-free benefit in the tax
Mm-hmm.
code, great retirement savings strategy for those who are eligible for them. No proposals at all to touch those. So,
Huh.
I consider it the ultimate retirement savings strategy because of the triple tax benefits, and no one wants to touch them at all. So, if you,
Well, and a spouse can inherit those. Explain how to leave that tax free to heirs,
okay,
HSAs.
yeah. Um, you put money in there. Most people, they put the money in, they take it out each year to pay their medical expenses. But a better strategy is to just put in the maximum each year, or have your employer put it in if it's doing that, and just let that money compound until you're retired.
Mm-hmm.
And then if you have excess medical expenses in retirement, you can spend them tax-free or pay for them tax-free from the HSA. Also, any medical expenses you paid out of pocket in earlier years and did not have reimbursed, you can reimburse yourself anytime down the road from the HSA. So if you need cash, just pull out your receipts from prior years and take a distribution to reimburse yourself for that. And then your spouse can inherit your HSA and have the same status you did. And then if both you and your spouse pass away, you can leave it to your beneficiaries. And the rule is that when they inherit it, they have to include the account balance in their gross income. However, they can reduce that by any unreimbursed medical expenses of yours if they reimburse the estate for them. So basically, say they inherit a $100,000 HSA, and you had, say, $10,000 or $20,000 of outstanding medical bills that had not been reimbursed. They can reimburse the estate from that, and they subtract that amount from the amount of the HSA that's taxable. So any unreimbursed expenses you have, medical expenses you have at the time of your death, they can use that to offset the taxable amount of the HSA and increase the tax-free amount.
Talk about one of the, we were talking previous and you were going through this list. One of the things I hung on to was what you called permanent life insurance. Explain that and maybe how it could possibly replace the stretch IRA that's been taken away.
Yeah, permanent life insurance, it's, life insurance lobbyists are very powerful. So
Yes, they are.
the life insurance benefits, they're tax-free to people who receive them. Also, with a permanent life insurance policy, there's a cash value account, and that earns interest and compounds tax-deferred or tax-free each year.
Mm-hmm.
So one strategy you can do is you have all this money in an IRA, traditional IRA. It's going to be taxable as ordinary income if you take it out. If you leave it in there and your heirs inherit it, they're also going to pay taxes on it, just as you would have. And under the Secure Act, they have to pay those taxes within 10 years.
Mm-hmm.
So for a lot of people, also income tax rates are likely to go up in the future. So you have to also consider, today's tax rate versus a future tax rate. So one strategy you can do is take the money out of the IRA, pay the taxes on it, use the after-tax amount to buy a permanent life insurance policy. So you'll be paying the taxes for your heirs. They would have paid them anyway if they inherited the IRA.
Mm-hmm.
But you're paying them now, and that's a tax-free gift, basically. It's not counted as a gift under the tax code because you're paying your taxes, even though it's really you're paying future taxes your heirs would have paid.
Right.
So you use that after-tax amount to buy permanent life insurance. And then if you need money in the future, there's that cash value account you can tap tax-free through a loan.
You can borrow that. This is where the sales pitch gets a little out of whack when some people say, "Well, you're getting tax-free income." No, you're taking a loan from the policy. All loans are tax-free because they're loans. That's not income,
yeah.
But you can take it from there. So yeah, I think that how does an irrevocable trust play into permanent life insurance?
Okay, and if you put the life insurance into an irrevocable trust, then that life insurance benefit won't be included in your taxable estate. On the other hand, you won't own it, so you also won't have the ability to borrow against the cash value account.
Got it.
So there's a trade-off there. Do you want it out of your taxable estate, or do you want to continue to own it and have access to that cash value account if you need it? So the life insurance benefit is eventually inherited by your heirs. It's tax-free.
Mm-hmm.
Also, the amount is locked in. It's not subject to market fluctuations the way a Roth IRA or traditional IRA investment would be. And for many people, if you're reasonably healthy and not too old, the benefit, the insurance benefit, is going to equal or exceed what that pre-tax value of your IRA was. So your heirs are going to inherit the same amount of money or more. It'll be guaranteed and it'll be tax-free. So that's the trade-off if you want to take money out of a traditional IRA, one that you are planning to leave to your heirs anyway.
Mm-hmm.
Instead of leaving them a tax burden, they're going to pay taxes on a traditional IRA. So they're only inheriting the after-tax amount. And if they take it all out in 1 year, they're going to be in the top tax bracket and pay the maximum taxes on it. So why don't you consider paying the taxes now, putting it in permanent life insurance, and letting them inherit the tax-free guaranteed amount? And if you don't want to do it in one lump sum, what you can do is just take distributions each year and pay annual premiums instead of the
Correct.
lump sum premium. So you
Yep.
can do it. It's a very flexible strategy. It can fit a lot of circumstances.
Mm-hmm.
And it's a way to reposition an IRA. There's a lot of people who have significant income and assets, and they don't really need everything in their IRA to fund their retirement. They're
Sure.
planning to leave that to their kids. And so you should plan to leave it in the most tax advantageous way. And one way to do that is to take it out and buy permanent life insurance with it.
Did Congress go after stuff like family loans? I know that that's something I've you've written about, and I've read the family loan stuff, and also maybe you can cover the family income, what we call shifting and splitting. Can you cover those two topics as well? Have they gone after those?
So far, those are untouched. So,
Okay.
one strategy that's really good, particularly when interest rates are so low, is parents or grandparents can lend money to younger generations at little or no interest. The younger generation, there are a lot of options. They could, for example, invest it, keep the returns and return the principal to the parents or grandparents, or they could use it to buy make a deposit on their first home or pay for their kids' education, something like that. And eventually, the parents or grandparents, they can forgive the loan, turn it into a gift. They could do
Mm-hmm.
that through their estate if they want in their will. But because interest rates are so low, sometimes the IRS will impute an interest rate and say, well, you actually had to charge interest on this, so we're going to treat it as though the parent made a gift of the interest to the child paid it back as interest. And when interest rates were higher, that could be a bit of an inconvenience.
Sure.
But with the rates so low, it's really not much money at all. You're basically lending money at treasury rates to your children. And so it can be a really good deal when your children or grandchildren need money or they have a good investment opportunity.
Which kind of leads us to the what you have written about the family income shifting and splitting, those type of strategies. I know that it can get somewhat sophisticated, but if you can give a kind of a broad overview, that's the reason people need to go to your site at retirementwatch.com, all one word, retirementwatch.com, because I know Bob has given you a fire hose of information, to say the least, understatement. But this is the type of information that you need as a retiree or someone going into retirement. Chapter 2, managing your money and managing your assets. You need to know these things. You need to know these things from someone who knows what they are talking about. That would be Bob Carlson. Bob, talk about family income shifting, splitting, and what you have referred to in some of your writings.
Yeah, it's good to look at not only your income taxes, but your family's income taxes, whether you have children or grandchildren. They're likely to be in a lower tax rate than you are. And if you want to help them anyway, it's best to help them in a way that minimizes the family's income taxes. So as a group, you have higher after-tax income and wealth. And there are a lot of ways to do that. For example, let's say you want to give some money to your children, and you're thinking the way you're going to fund that is to sell some stock or mutual funds and give them the money. Well, these likely have appreciated a lot. So if you sell them, you're going to have to pay capital gains taxes and then give the after-tax amount. What you can do instead is make a gift of the shares themselves. Let your children or grandchildren sell it. They're probably in the 0% or 10% capital gains tax rate
Mm-hmm.
versus perhaps you're in 15 or 20%. So let them sell it, pay less taxes on it, and have more after-tax money to spend than if you had sold it and given them the after-tax amount. And there's a lot of things you can do with that. Say you have income-producing assets. The income exceeds what you need to live on, but you're including it in your gross income and paying taxes on it. If you're giving money to your children or grandchildren anyway, why not give them those assets and let them have the income each year, pay the taxes on it at their rate?
Mm-hmm.
And so again, there's more after-tax wealth in the family if you learn what your children's and grandchildren's tax rates are and give them with that in mind rather than paying them from your after-tax leftovers.
Um, are our friends in DC, are they going after the step up in basis on inheritances? What's happening with that? Because I would think that would be a target. What are you hearing?
That was initially a target. Um, Apparently enough people have opposed it for
Hmm.
now that it's
Yeah.
off the table, and that's why they've come up with some of these other plans to pay for their spending. But for now, the after-tax step or the step up in basis after death is still viable. It's still available to everyone, and it looks like it's not going to be changed anytime soon.
How about the old standby 529 plans for education savings and things like that? That's been around for a long, long time. I don't think it's ever caught on fire like they thought it would. Are they leaving that alone because of that, or are they pointing a gun at that one?
No, they're leaving that alone. In fact, over the last few years, they've enhanced some of the benefits in the 529 plan.
Okay.
529, excuse me a second. So that, excuse me.
No, that's fine. Yeah, you can go ahead and get what Bob was talking about, the 529 plan, which if you're not familiar with it, it's a way to fund education costs for kids and grandkids, et cetera. And it's flexible. And I like the fact that Bob looks at it in a different way from an estate planning vehicle. So maybe he can go over what a 529 means from a estate planning standpoint.
Yeah, in fact, the 529, it's really a great estate planning tool. You can make 5 years worth of tax-free gifts in 1 year. So you can shift $15,000 times 5 out of
Mm-hmm.
your estate, put it in an account for one child or grandchild. It's in there, it earns tax-free income.
Mm-hmm.
If they take it out to pay education expenses, it's tax-free again.
Mm-hmm.
If you change your mind, you can get that money back. You can change the beneficiary. You can choose how it's invested within certain options provided by the 429 plan sponsor. So it's really flexible. It gets money out of your estate tax-free, benefits your children or grandchildren tax-free, and unlike a lot of strategies, you can change your mind. So it's again, as you said, this is a very flexible strategy that has not been used as much as the financial service industry thought it would be.
Mm-hmm.
Not clear why,
It's
because
because that's because advisors can't explain it like you do, Bob. If everybody could explain it like you, it would be one of the most popular things on the planet. But yeah, I agree. I think that people probably need to revisit it, especially people in chapter 2 of their lives where they're looking to move assets around, take care of family, etc. It's not just for education anymore, as they say. There's other things that 529s can do.
yeah, and they've expanded it in recent years, so you can use it to pay for pre-college expenses. You can use it to pay for private schools. Uh, Really, they've continued to add to the list of the tax-free expenses that can be paid with the distributions.
Um, as you were talking about the 529s, I'm pretty familiar with it because I've seen them forever. Something hit me about have they targeted donor advised funds or when you start bunching up deductions and things like that? And if not, why haven't they? Because I think that would be a common sense, target or, you know, before you answer that, how, in your opinion, how does Congress go about the targeting? I know it's a lobbying group and all that stuff, and there's a lot of how the soup is made is pretty, and how the sausage is made is pretty ugly. But some of these things I would think would be easy targets and easy sells from the standpoint of the media pushing it, et cetera. And of course, they're horrible messengers on all this. Why do you think some things make it through untouched and some don't? What's your opinion on that?
Yeah, well, in particular for the donor advised funds, the charitable lobbying groups are quite good. In fact, they've been able to expand the tax benefits of giving while a lot of these other benefits are being cut back. So a part of it is very powerful interest in charitable giving. Of course, a
Mm-hmm.
lot of the rich people also favor a lot of the charitable giving tax breaks because it helps them. But that seems to be the main thing. Also, the charitable groups argue that they're really doing some of the functions of government through their charitable activities. So if you cut back the giving to the charities, then someone's got to step up and replace what they're doing. And so,
That's true.
you
That's
can either
true.
give away the tax breaks or you can do direct spending, but someone's got to do it. So that's really a lot of what keeps these charitable tax breaks going. And the donor advised funds, there are some people in the charitable industry who actually want to cut them back. Their argument is that people put this money into the donor advised funds, they get the upfront tax breaks, and then the money sits in the account for years or decades. They have some data about what a low percentage of these funds actually get paid out each year. So there is this small and perhaps growing group that's making an argument against the DAFs. But for now, they've not been successful. The DAFs are in place. There's no strong movement in Congress to restrict their benefits.
Hmm.
The only thing that arguably restricted their benefits is there have been a couple tax breaks in recent years, such as the qualified charitable distribution and the increased charitable deductions that were allowed during COVID. Those breaks were not allowed for contributions to DAFs, only to public charities. But other than that, the donor advised funds are in place. You can put the money in there, get your current charitable deduction for the full amount you put in, and then you can dole that money out over the years, and in the meantime invest it so it grows in value, and so your ultimate gift to charity exceeds what you put in and what you got a tax deduction for. So so far it's got enough people backing it that it's in place, and there are no
Okay.
plans to restrict it.
How about bunching deductions? I mean, we've talked about that in the past on, when we were speaking at all these other events and we've discussed that. Did that make it through? Does it look like that's going to get through untouched, unscathed, and bunch? And maybe you can explain, how you can take a standard deduction and increase that, et cetera, which we call bunching deduction, bunching up the deductions.
Yeah, the bunching has become more popular after the 2017 tax law because the standard deduction was doubled, and you can only take itemized deductions if your total exceeds the standard deduction. So fewer people could take itemized deductions after 2017 because of the doubling of the standard deduction. So one way to increase your itemized expenses is to bunch them all in 1 year.
Mm-hmm.
Take 2 or 3 years worth of expenses and put them into 1 year, so you exceed the standard deduction for that year and you get the tax benefit. And the charitable deduction is the main one to do that because you can use the DAF. If you have the cash, you can put several years worth of your expected charitable deductions into the DAF, deduct it this year, and then dole it out gradually over the next 2 or 3 years. You can do that to some extent with other expenses. For example, with property taxes, you can pay them in December, pay like January's expenses in December and get an extra month in. Although those are not currently deductible, they won't be deductible. Well, they're not deductible above $10,000. So there's that limit there. So the main one for bunching is charitable. You might also bunch medical expenses, but if you're near the standard deduction amount but not over it, you might want to consider bunching some of next year's deductible expenses into this year so that you can get over that standard deduction amount and take that extra tax break.
One of the things I like about your site, once again for everybody, and the reason I keep saying the site is there's no way you're retaining all this. So it's good that all of this is recorded for my listeners, clients, viewers, et cetera, because you're going to have to listen to it and go to retirementwatch.com. One of the things I like that Bob does, obviously he knows his stuff backwards and forwards. As you know, everyone nod their head to that because that is true. But one of the things I like about your site, and actually when I hear you speak, you talk about tax-wise investing, and I think if there was ever a time to probably take your advice and maybe you go through some points of what that means to you and what that should mean to the listener. Tax-wise investing is going to be a sport upcoming, believe me, because they're going to have to raise taxes to pay for all this money they're printing. So, Bob, do the listener and viewer a favor and kind of go through some bullet points on what tax-wise investing means.
Yeah, a lot of people don't consider the taxes on their investments until near the end of the year, after the close of the year.
Mm-hmm.
But there are things you can consider during the year, in addition to what's going on in the markets, that would increase your after-tax returns. Loss harvesting is a good one. Many people just psychologically, they're hesitant to sell a losing investment.
Mm-hmm.
Various psychological reasons are given for that, but the point is, people don't like to sell their losers. They say, well, I'm going to wait till it gets back to what I paid for it, and then
Right.
I'm break even. But a better strategy if you want to look at your after-tax returns, is once an investment's gone down, it looks like it's not going to turn around anytime soon, sell it, take the loss. You can deduct the loss on your tax return. It can offset whatever capital gains you have for the year.
Mm-hmm.
Any excess loss up to $3,000 can be deducted against your other income. And then if you still have an excess loss, it can be carried forward to next year and used the same way. So instead of leaving that money in this investment that's not going anywhere, sell it, get these tax benefits, and then you have the sale proceeds. You can invest in something else that hopefully will at least go up a little bit instead of languishing there.
Mm-hmm.
So, tax loss harvesting throughout the year. Some people wait till near the end of the year to do it. But, better approach is, monitor your investments all year. If something goes down significantly, even if you think it's temporary,
Mm-hmm.
you can sell it, book that loss, wait more than 30 days and buy it back. Or you can immediately buy something that's not substantially identical. You can sell one index fund and buy another index fund, or sell one energy stock, buy another energy stock, something of that nature. So if you're thinking about the tax effects all year long and watching the market, when the market goes down, instead of fretting about it, think, what opportunity do I have here where I can book some of these losses, offset some of my good investments, and then reinvest this money in something else. So that's a good strategy. Another strategy, don't sell an investment just because it's gone up. Try to wait till you've held it for more than a year, so it's a long-term capital gain instead of a short-term capital gain.
Well, that's a basic one that people need to really remember.
Right. Most people, they want to take their gains, hoping they don't go away. So instead, they're paying ordinary income tax rates on a gain, when if they'd waited a little bit longer, they'd be paying long-term capital gains rate. Even if the investment goes down a bit, the difference between the tax rates often is so significant that it has to go down 10 or 15% before you'd lose by letting it convert to a long-term capital gain. So that's a pretty basic thing that most people don't consider, is just waiting to let that mature into a long-term capital gain instead of a short-term gain.
Is there anything that, talking about tax-wise investing, anything to be aware of? Any gotchas on the horizon there?
There's not a lot going on with the investment rules right now. There were talk of increasing the capital gains rates. That, as far as I can tell, seems to be off the table. It might come back, but for right now, these basic investment rules that increase your after-tax returns, they appear to be safe.
That's good. That's good. So overall, are you, to me, you're just even-keeled, you're a realist. I guess I'm a pessimistic realist. I think you're an optimistic realist. Both of us being realists. What's your crystal ball say? Is it going to get ugly from the standpoint of taxation? Are they going to mess with the Roths? If you were going to kind of close it up and put a bow on it, not holding you to it, but I just, fascinated with your brain and where all this is going. What do you think is going to happen? Or are you just going to wait for the dust to settle?
Well, when they made these big proposals earlier in the year, I thought it was a bit of an overreach, and most of them wouldn't pass. The real question to me is, did they overreach so much that they can't come to agreement on anything?
Mm-hmm.
Or are they going to be able to kind of realize what the reality is, and that, they can get some of it, but certainly not all of it? Today, I'd have to say it looks like it's 50-50, whether they get nothing or they get some of these tax increases that they want. And, when they first proposed these things, they said, what we've learned from the past is we have to act quickly. We have to get what we want as soon as we can.
Mm-hmm.
That hasn't worked. The process slowed down. People started revealing what's in these laws, and people started objecting to them. Also, if they don't pass anything this year, next year, a lot of people in Congress and the Senate are up for re-election. There's a lot of people who barely won their seats last time. They're kind of marginal, and so they don't want to go with any of these extreme proposals. That argument makes me a bit optimistic. I still suspect they're going to come together and get some kind of tax increases in.
Sure.
It's just not clear at all which ones, because it changes from day to day, which ones the media says look likely to get agreed to. But the good news is those big proposals that were on the table in the spring, most of them are off the table. And the question now is which of the lesser proposals are going to get through, and is it going to be restricted to just the very wealthy, or are some of it going to trickle down soon to regular people and middle class, upper middle class people?
Well, certainly. I wanted you on today just because I wanted to get people prepared, kind of let them know your insight on what you think is going to happen, what's going to be taxed, what they're looking at, what's probably not going to be touched and is going to go through. And I think we've covered that. But as people have been listening, what I would encourage them to do is don't listen to the media, because most of those people can't spell the word tax. They don't know what they're talking about. They're trying to get clicks and viewers. Go to Bob's site, retirementwatch.com, and he's going to give you the facts of what's going to happen, what you should be aware of, how to address it, and how to make an informed decision based on your specific situation, with him providing the facts, which is the reason Bob Carlson is who he is, which is America's #1 retirement expert. I mean, I'm not the only one that said that. Many people have called him that for the reason that you've heard. He is a veritable plethora of information and a fire hose of facts. So Bob, I really appreciate you being on. Every time you're on, my emails light up, and everyone's just like, oh, that was so great. Please have him on again. Bob, we need you on again once all these laws are passed, and then we'll sift through the bodies, as they say, and you can tell people what really happened. Okay?
Well, I'd be glad to. You're doing great work for people there, and I'm happy to participate.
That's Bob Carlson of retirementwatch.com. I encourage you to go there, and I appreciate everybody joining me on Fun with Annuities, and I will see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.